For the global managers and the investment universe where you can invest in real estate anywhere, looks like we're looking really good from a yield perspective compared to the rest of the world. Are you seeing conversations about increased allocation to U.S. real estate?
For the international capital coming to the U.S., they are putting bottom-up polls.
Great. Rodrigo, for those who don't know me, I work for Capital with Ron and John, the group here. We run the Cornell alum for real estate. Happy to have Harry join us. Harry just relocated from Hong Kong a couple of months ago, global head of research for CBRE. So should be a treat for everybody here, and hopefully going to have a little bit of time for Q&A after this.
Sure.
And we'll go from there.
Thank you. Thank you. Thank you. Thank you, everyone. And it's great to be here today. And I have to say, this is my first gig in Dallas. And it's great to be here today. And I live in Dallas for 11 months now. I'm a Texan. I'm so happy to see people in my professionals here beyond CBRE. And I just relocated from Hong Kong September last year. So time flies being here for nearly a year. I was running the Asia Pacific research in Hong Kong together with the capital market research globally and out of Hong Kong. And then now they offer me the opportunity to come to the US. And so here I am. A little bit background to myself is I am Taiwanese, and I grew up in Taiwan. I did my postgrad in the UK, and I started my career in the UK. And I just probably like many of you, I never thought I worked for the brokerage company, because I think the brokerage company is sometimes it's just always the sales side out of London, and the PGIM, you know PGIM, out of Hong Kong, and also seconded to China, working for Chinese sovereign wealth (CIC) during the greater financial crisis. So you can see my background is all about capital market, all about capital allocations, all about the strategic investment. And by being at CBRE, the aspiration is we produce something so similar to every other people. As a client, I don't read. So therefore, that's why I took the job. We want to create something different based on our data to create some insights. So today, I want to talk you through all about the US. And of course, if you got some different questions about, I'm more than happy to answer. Okay, so quickly going through, I think this is quite a standard slide. I always feel like people can be overly negative on Trump. Whether your political incentive or not, it doesn't really matter, but you have to say, Trump is doing something good, doing something bad. What he does is something good. Is actually deregulating the business. It's a group for growth, right? But that happens impact is going to a medium terms. And then he also talking about the good things. This is one. The bad things is those two. You know that the tariff, the trade uncertainties is going to create a lot of headwinds for the growth. And what we are looking at the real estate market and the economy situations, as of now, we think about the interest rate will cut twice this year, but it's meaningless. I'll show you the slide later on. Fundamental very, very strong. We do have a supply chain disruptions. That's why some market, some sectors are probably going to outperform. The labor market need to watch out very, very close. But nevertheless, the unemployment rate is still relatively low in the US. So we can talk about it later on. But it's the trade and the tariff uncertainty, something we really, because we are in this era, so people love to talk about geopolitical issues. So the line shows you the G7 is the unemployment rate. So you can see the cycle is nothing to do with the geopolitical event. So people say, oh, a geopolitical event is changing the economy cycle. But you can see through the past 40, 50 years, it wasn't an issue. However, why? So the tariffs are so big to our economy cycle this time. Why? It's because you can see from 50s onward, you can see our tariff is very close to zero. But now you can say shooting out tax, you see why people start talking about that. But historically, it will be an issue, become a major issue. As a result, what we are expecting for the GDP, I have to say Fed had a tough job to do. You can see this line shows the GDP. This is the GDP. GDP, we are going to not recession, but it's below the trend growth. It's a definite lighter color, it's GDP. You can see it's below the trend growth. Over the past few years, we got a decent economy growth. Going forward, it's definitely below the trend. For CPI, it's sticky. And then we are not expected to see the CPI to drop below 3%. Okay, so you can see over the past cycles, you can see the nice correlations between CPI and then GDP. This is a more interesting slide, which I don't think you have seen that slide before. So gray line shows the US CPI numbers. Not very clear. The green line shows you the policy rate on the upper range. People tend to talking about, okay, when are we cut the interest rate? When are we going to the interest rate? But for me, it's the cut the interest rate. Once you make the first cut, what is the next 12 months? How much the rate cut is going to happen? I have to say, before the tariff happened, we already forecast it's going to be 200, 250 cuts since the end of last year. Again, because of tariff, you can see that cut only 100, nothing has happened. But continuously, we expecting to see cut in September. We're probably going to see another 100, 125 cuts by the end of 2026. That's our current house view. But you can see for the past few cycles, you can see the cuts could be quite substantial. The minimum 150 bips, maximum during the greater financial crisis is closer to 500 bips. So I think the timing becomes increasingly important. So that's why we think about September going to be first cut. Going forward, 5 cuts. The labor market, this is something I think you can see the private sector is dragging down. But you can see for the education and healthcare, you can see become really, really resilient because people need to go to school, people need to go to hospitals, so that will be resilient. But we do see the softening in terms of from the labor market, particularly driven by the government as well as for the private sectors. But the headline was making so hard for us to say, oh, wow, labor market was so bad. But actually, if you look at the US forecast, the unemployment rate is just above 4%. 4% is not that high on a global standard. So therefore, I think the strength of labor, softening of labor market will continue, but it's not what we're seeing here, not what we're seeing there. So that's the current situation we are facing. There's a huge disconnection between the soft data, sentiment data, and the hardline data, the hard data. So therefore, it's so hard to make the forecast. So you can see the CEO's confidence is moving all the time. It's recovering. That recovering is not because economy is doing fantastic, it's doing so well. The recovering is there are less uncertainties. Because the CEO wants to make a decision based on what they can forecast. There's a certainties. But when tariff uncertainty will gone, all the tariff will be in place, it's not going to be gone, they can make a decision, they can make a plan. So you can see the bounce back on that part. For the consumers' interest, their confidence is not great, but retail sales seems to be relatively resilient as of now. So that's why we keep saying the sentiment data and the hard data we are seeing shows a huge disconnect as of now. That's why the Fed is having in between, don't know how to interpret the economy. But nevertheless, to my surprise, as of now, U.S. economy performed relatively. And then this is the one thing I think we all as investors, we worried about it, is all about the deficit. So the U.S. deficit, again, if you coming from global economy, just it's not bad, only 8% before the GDP. But actually, when we compare our peers in G7 outside the US, we are dragging. So that's why the investors are pricing in for the 10-year Treasury is a lot higher. No matter the short-term interest rate going to cut, unfortunately, 10-year Treasury is going to be lingering around for quite some time. It's above 4%. I know when I was even with Deutsche Bank at that days, before people always talk about 4%. I don't know why, but sentimental benchmark is 4%. Anything below 4%, people start to trade. Anything above 4%, people become very cautious. but clearly we are not going to hit below 4% based on the current forecast, based on what we are seeing on the economy for now. So let's talk about capital markets quickly. This is what we are looking at our lending, because we've got a big lending platform. We get our lots of CBRE data. We create an index. So you can see we are seeing the market has recovered from 2024, and the lending momentum, the deals coming through quite substantially, and that we dip. The dip is pretty much driven by Q2. The Q2 data is because of a tariff. The lending market just gone. And now we can see uncertainties coming back, so we can see lending is recovering. So therefore, the lending market into the investment volumes. Okay, we all feel good about it. The market has passed the bottom, right? The volume is going to increase by 5, 10, 20%. Doesn't really matter. But what I want to highlight here is, if you look at the 2025, that's projected as a 10% volume growth. It's 2014's level. So we are far from the historical peak. We are far from the past 10 years average. So we got a long way to grow. And yes, it's past the bottom, but again, it's better, but not as great as what we used to have over the past 10 years. That's something I want to highlight. This is so interesting about the cap. When I was running Asia Pacific, and last year I was in Australia, I was even being quoted by on the Grade A office building in Sydney. Last year, have wild guess what's the cap rate? Last year.
Are you talking about the big Blackstone office building in Sydney?
Can the similar quality?
Okay, well, I'll recuse myself because I know the answer.
Do you know? Oh, what I want to tell me, what do you think? The cap rate? 7. Wow.
4.
Me fours. Okay, at that time, I put my money into the 10 deposit for HSBC for a year. The risk, cash, right, a year. The interest rate is 5.25. So that is crazy. So therefore, we are keep talking to the Australians. No, prime office building is excellent. The 475, we are not moving. 5% maximum, we're not moving. I said, guys, you are crazy. And then no one will buy Australian properties, period, if you're not repricing. And then we don't see that happen until early this year, because a lot of developers, a lot of REITs, they forced to sell because they can't get a finance, they can't get an extension of loans, they can't get a funding, they need to sell. So the price has been reset to high 5 to low 6 now. So that is the opportunity to continue to happen. This is the US. I deeply believe American real estate market is so attractive purely from a pricing point of view. Look at the cap rate on the level. It's so high. I was in DC on Monday to Wednesday. I'm looking at the market. I walked through the market. I realized that DC was not as bad as I thought from the newspaper, period. And then I was asking about the trophy buildings, about office building, the cap rate. Do you know how much is the cap rate in DC now?
10.
9 to 10. I said, wow, this is so cheap. Because that's why I'm going to Asia in October. I'm going to do the investor conferences. I would say, guys, Asia is getting so overly priced. American become very attractive. But when we are sitting in the US, we feel it's not enough. But nevertheless, what we are thinking about, the cap rate has already, moving, is going to be coming down. And we think we picked the cap rate pretty much across all the different sectors. Again, that's why we talk about the proprietary data. We are looking at all the different cities across the US. This is the survey we did in 2024, second half of the year, the cap rate. This is the first half of 2025, the cap rate. Where we're doing this different color means a different sector. Did you realize all the points are closer to this line? That means from the survey point of view, we probably think about the cap rate, it's not going to decompress moving out any further. Pretty much we reached the peak of the current cycle on that part. However, when we have a deeper dive about Grade A, prime, versus non-prime, you can see the outliers. Here's offices. The cap rate between prime in office and non-prime office has expanded even further. So that's quite fascinating. All the other market is kind of trending down, but the office is a bifurcation. But for me, the office is excellent. The wider the spread is, that means there are lots of opportunity for investors to look into their offices. This is a very boring that return, negative returns. We can see finally we are moving positive rental growth. This is quite interesting to look at debt maturity profile. I think you can see in 2025, I think when I was in Asia, I thought the US should have a distress because you got a huge debt maturities coming to the market. But surprise, surprise, the private debt has been extending. The bank lending has been extending for 1 year, 2 years. So that's what we are seeing has been pushed back. The only segment that hasn't been pushed back so much is the CMBS. So CMBS is the source of default and distress, and that's what we are seeing. And second component is the multifamilies, even for the banks. If you reach the maturity, we do hear more and more banks say, oh, I'm very cautious about multifamilies. So now, not anymore. Office is default. Even now, multifamily, we do see a lot of feedback on that part. But nevertheless, you can see that debt maturity still remain a major issue. And that's watching other spaces on that part as well. We on the capital market front, when I was seeing the capital market, that's all I care. Rental growth and the cap rate. However, I think it's increasingly to understand the fundamentals and what occupier want. The first one, just looking at the market, this is a US market. US is massive. We are seeing, finally, on a national level for the offices, the vacancy rate is trending down. Supply, not much supply, we all know that. Demand is recovering. However, the demand is pretty much coming from the price segment. When I was breaking down from the country and the cities, you will realize all the prime segment has a stronger recovery. But also the latest trend, what we are seeing, the spillover demand is coming through from prime to A, from A to A minus, because there's no space in prime anymore. So as a small investor, probably I won't go for prime. For those early recovery markets, we should look at the value add opportunity because the price hasn't recovered, rent hasn't recovered. That is something we should look out for. Occupier told us, that's the data we collect, not CoStar data or our own data. You realize, historically, the new leases is a sign expansion, but because of uncertainties we are seeing from the tariff, something, we see a higher percentage of renewals. So occupiers still want to renew us. But we also notice when occupiers are telling us, this is a great, like a Dallas, Preston Center, the vacancy rate is 3%. If like a space is there, they know they want to be Preston Center, they will move there. The right location and the right price, either they will move there because they know the segment is very, very tight. So therefore, what I am trying to do is talk about real estate is all about cycles and the cyclicals. So you can see the blue bar here is the TTN's value changes, value growth. And then the line here is for the next 3 years, what the value is going to grow based on our forecast. Who are the winner and who are the loser as well. So that's why we are talking to, this is coming from occupiers. Occupiers say to us, this is what we want. I want the physical, I want the human interaction, also want the digital. So this placemaking is increasingly important. That's why Preston Center is very good. That's why Eastern in DC was very good. That's why Midtown in New York is the first one to recover. So this is something, office enhancement. Even now we go spill over demand for A minus, B plus in the right location. If you bring those elements into your portfolios, I think you can enhance the returns. Especially there's no vacancy in the prime segment. Industrial logistics is quite interesting. I think Asia is well ahead of the curve in terms of the the fundamentals and structural changes, where the heads in terms of the demand supply dynamics and structural changes. But this is the US. The good thing for the US is we do have, it's quite interesting to see that goes up and goes down. So I want you to pay attention for 3PLs. It continue to go up, but let's go one step deeper to talking about the 3PLs margins. This is something I always believe, and that the music has to stop at some point. If you don't have a good product, logistic rent cannot continue to grow forever. While we're talking to the occupiers, and they are telling us we overexpand, my margin has shrink, and I need to rent renewals, but rent has increased by 80%, 100%, depends location by location. So therefore, they go through the portfolio optimization. They say because the margin has come down, you can see some of margin are very low, therefore they won't be able to expand meaninglessly. They need to be very strategic on the right location, on the right asset classes. Structural changes, what the right asset class will be, going to be a future. This is the modern logistic facility, what they are telling us what they want. I'm not an expert on that part, but they tell me the grid, the ceiling height, the loading, and loading bay ratio, specific. Now they're also talking about the power supply become a key element. When I was engaged with those occupiers, I said to them, guys, rent is so cheap, let's build a ramp-up logistic. Second floor, third floor, fourth floor, more efficient, more cheaper, right, for you guys. They said, no, we do not want to have a ramp-up logistic. We only want one floor, maximum two, ideally one, a big massive play with all those features. So if you had an asset, you fit those criteria, I think we are outperform. If you don't have those criteria, I think when you have the rent renewals, you're going to have some challenges of underwrite a stronger rental growth. Retail, boring stories, is no supply, so supply keeping dropping off because the retail hasn't been a darling for such a long time. And the net absorptions, it was not great. It was on the way to recover, I have to say, because of a tariff. So retailers become super cautious about taking on new spaces. But again, they are talking to us, want to fly to quality. So good quality, power centers, lift workshop segments, they will continue. But when I was presenting to retailers really don't care about those. They want to talk about consumer trend. This is quite interesting. Do you know what Labubu is? Actually, I didn't know that until early this year. And then I was shocking. I also realized we do have a pop mall here in Dallas, but I just can't get Labubu. So this is quite phenomenal. Here, even in Dallas, we got a long queue for that. That's a consumer trend. So therefore, you can see they need to attract lots of retailers, the consumer trend. You can see, I just use an example from Asia Pac. You can see the Labubu have a Beijing, Shanghai, Oxford, in Sydney. They all pay for the city rent, the expensive rent, to aggressively. And I was in London the other day. I said, what is this shop? I had a long queue outside. I didn't realize they sell Labubu. Let's tell you how ignorant I am. But you can see they even buying the building. So the consumer trend become very, very important. So if you are talking to the retail spaces, talking to retailers, that's what retailers are talking about now. It's all about the value for the product, for the emotional, or you attached to that. Brand value, space value, and ESG value. When you're talking to your tenants, that's what all they care about. What I can show you is the Sunbelt market is facing some tough challenges. And because the Sunbelt market is over, we see the bottoming out, but it's not across all the major markets, every single market. And so 2027 second half, we'll see the widespread of recovery. So final part, just quickly to go through. That's what I love to do, is real estate investment strategy is all about play the cycle and overlay the structural changes. So if you're thinking about it, I think for data center, it's easy to understand, right? No point to address this. And then for retail, we'll be talking about, on the cyclical outturn, we do see the life was struggling on that part and lagging behind. And then for offices, again, for the cyclical point of view, We are tracking 90 markets. I think more than 50%, 60% of the market has already seen a positive rental growth already. So the widespread of recovery will continue. So that's one thing. The second thing is we need to overlay the structure of what occupier wants. You will create the investment strategies on that part. Industrial, I have to say, if you make the investment in 2020, 2021, I will sell. People still believe it, the story there. I will sell to realize a return. I will redeploy the capital into the facilities and what I highlighted. And we also noticed that by engaging with the occupiers, with the cities had a direct access to Mexico, we outperform. So Texas is one of the major markets we're going to see the outperform. And then that's very clear on the leasing demand side, the occupier side on that part. Multifamily, again, similar. If you bought in Sunbelt in 2020, 2021, you make a decent return, probably time to sell as well. And then for the vintage, what I'm talking about the vintage is something only happens once in a while because of a macro condition has changed. So number one is credit, higher for longer. So therefore, credit strategy is new equities. So I think credit is definitely something to look out for. Public to private is also important because REITs, they are trading at a certain sense. Talk to the REIT, say, I'm going to take you to private. You're trading at a 40%, 15% discount. On the private market, 11, 12% discount. So that's the arbitrage, win-win situation. And we do see more and more deals coming through the course of 2025. And the third one is something we need to talk about sell and lease back. Because of a tariff, some industry will have a huge impact on their cash flow, on their margins. Therefore, you should talk to their company and say, why don't I take over your real estate portfolio, lease back for 10 years? That's a perfect strategy for core plus funds. And that the only way it happens when you had uncertainties like well experienced.
Can I ask a couple questions?
Sure, please.
Okay. The first one, when we're looking at unemployment in the U.S., I know we're one of like a few countries that takes out the people no longer looking for employment from those numbers. And I'm curious how you've seen that differ in other countries, and if maybe now, in a time where so many people are more on social media, doing side hustles at home or whatever, if all of those things are taking a lot more people out of the data, and we're maybe understating that.
Fair. That's a fair point. I think the only market who has at least a situation is mainland China, right? And then beyond mainland China, I think the other one just like a normal practice. You are right. That's a good point. But when we look at the headline data, you feel like it's not bad. Yeah, I never thought about it. It's interesting. Yes.
And then my other question was, just because we had the two funky years between 2022 and 2024 as it pertains to the yield curve inversion. So I'm curious as to what your thoughts are on whether that's still a good predictor of incoming recessions in the future, or the last couple of years kind of erased what we used to think about the yield curve in terms of.
It's very interesting. We never talk about I haven't heard anything for yield curve for such a long time. Do you realize?
Right, yeah.
We haven't talked about it for 18 months. And then that's why I think probably the way the economy performing is somehow a little bit different from what we used to do. And then, by default, recovery of economy dropping under inflation is warrant a rate cut, right? That's by default, we understand. But if you look at the unemployment data, if you look at the inflation data, again, it doesn't make any sense. So I really don't know. I don't have a crystal answer for that, but I do think about the traditional wisdom might not apply for this cycle because of a tariff, because of policy. We do worry. The recession, I do worry about the policy error. But no one can predict what, everything is based on one people's behavior. That's quite hard to do.
On cross-border capital flows, you've probably a lot of your clients all over the world. For the global managers and the investment universe, or investment real estate anywhere, looking really good from a EU perspective versus the rest of the world. Are you seeing conversations about increased allocation to U.S. real estate?
It's interesting. I talk about that's two fronts. One is when we are talking about U.S. insurance institutions, because of the policy uncertainties, they want to diversify their portfolio to the global market. The global market means the mature market. They want to do Western Europe as well as APAC. But Western Europe means one country, UK. That's it, right? And for the international capital coming to the US, they are putting a bottom up because they say the uncertainty is just too high. And I just don't want to have a coming here on the policy area front. It's not in a rush. The cap rate, the 10 years high, the cap rate is not big. It's not going to compress that this way. So I'm going to wait for a while. But when I go back to Asia, we're talking the NREF, like your NACRIF conference with all the Asian investors, and I was saying, look at the US, it looks very attractive. And then from the pricing point of view, from the rental growth point of view, it's bottoming out. And then it makes a lot more sense to come here. But we just, all the headline doesn't help us. All the headline doesn't help us. But from the mathematical terms, investment return terms, it makes a lot more sense. Okay, for another question. Wild guess, grade A office. Not grade, we don't trade grade A office. Let's say B office in Tokyo. What's the capital? 375 to 425. It's crazy. It's literally crazy. But that's how they're trading. They see in Tokyo is risk-free. But I say Tokyo, in my mind, is peaking. Just because uncertainties, you guys are crazy in the US. They continue. And I say, Tokyo, I will show Tokyo. But anyways, but people continue to put money into the Tokyo. But once Americans, actually those uncertainty gone, recovery, you can see equilibrium change. People were coming here, they will ditch Tokyo. Just simply crazy numbers. It's 375, 425 now. So that's why I think for the real estate community, we should put in a global, I love to use the global risk-free rate, cap rate, just show how attractive it is here in the US.
How do you think, I was going to ask you, how do you think about real estate investment as a whole in comparison to private equity, hedge fund, all those AI investments? And what I mean by that is, I do feel like over the last 10 years or so, people actually know how the data report, and also, it also feels to become very saturated, meaning getting the alpha is becoming very challenging, right? So if you're a sovereign fund putting money out there, and to look at it from a whole portfolio allocation perspective, whether it's real estate, whether it's hedge fund, whether it's infrastructure investments. I just got a feeling that there's too much capital chasing too less deals over the last 10 years within real estate. So by definition, you're seeing limited returns within the sector. And from an allocation perspective, I'm Eastern hedge fund, I got $1 trillion to invest. Am I going to increase more allocation to real estate?
Yes.
Or is it time to keep my denominator if I can take less money in real estate? So that's kind of, I've been wondering about it for the last couple of years.
So you are absolutely right. It's because I was talking to the Singaporean sovereign wealth fund a lot when I was in Asia, right? And I said, before pandemic, they don't do fund investments. They do co-investments. They do direct deals. That's their strategies. But they realize they got so much money in their book. So everything. The second one, yes, I do agree. For hedge funds, they do increase the allocation into real estate. They pretty much, they're looking at the number. There's a number again. But the beauty for real estate, in my mind, because stories, you got lots of asset enhancements because every asset is very performed differently. So how do you turn around the asset enhancement? That's the beauty. And then that's why you get the juicy coming from. So therefore, I don't believe a hedge fund will outperform because they don't have asset management capability, just like a PE funds. They just turn around the companies. Because real estate, I think that in the future, probably the asset management is more important than ever because that's what occupier wants. We need to create a product where your tenant wants to be.
I wonder a little bit about kind of the logic of what you're saying too. You're talking about how because the information market has become more efficient,
It's more transparent, yeah.
right? Then there is fewer deals, I guess, for the same kind of amount of money, or maybe even more money. Do you feel like that kind of follows, that because information is more transparent, more efficient, that there are kind of fewer deals for the same amount of people to fight over, or do you feel like one still follows from the other?
It's quite interesting. We owe that. No, we feel that the information is very transparent. Is very. I just give you the classic example. In CBRE research, we operate. We call America's research. We collect all the data on the proprietary information. We collect all the data beyond CoStar. So we all have the econometric advisors, which is a think tank that produce the forecast about the market. I can tell you that all from CBRE, the two data cover two markets, the data is different. And the overall market might be the similar, but the sub-markets, rent, directions, travel can be very different. So therefore, by outsider, we think about it's very transparent, but in reality, it's not. Real page.
And everything else, like wildly different.
Mm-hmm.
I had one deal where I could not figure out these rents in the market. The data didn't make any sense. So I pulled the same exact properties from CoStar, and then I started going through apartments.com one by one. Like, what are they actually listing these apartments at? And then I called them and I pretend I'm moving into the building and I ask them if they have anything for free, and see like what they'll actually offer me. And the conclusion of this thing that took me like a week to gather data is that every single one of those resources that I used was wrong in a different way. And you can kind of take an average and hope for the best, which is the best way to get to it. But the true numbers are so dependent on so many different things, especially for multifamily. They might be changing those prices on that website on a daily basis. Or they only found somebody who's going to pay a little bit extra for that, and so the next guy's going to pay that. And it depends on what the bigger managers are doing too. So Greystar makes the adjustments to try to hit the occupancy numbers, for example. So the conclusion is, it's like the
It's not
best
transparent.
estimated
Yeah.
guess you can possibly.
Or brand investment sales shops from CBE and all over different shops all over the country, specifically for industrial. Common theme is that the core funds are just not there, right?
Yes.
The stuff that's 7+ years of lease term credit, 10 years plus, big bombers, they're just not in the market. They haven't been in the market for a while. So based on what's going on right now, it looks like from your chart, Treasury view is that it's going to be going up for the foreseeable future. When are they going to come to the market? I mean, they're going to just sit there for the next 3 years and not deploy capital that's been invested and expected.
It's so funny. I spoke to a couple of friends who are in the core funds. I said to them, "Don't you think you should time for sell? There's no point to buy then at this point of time." They say, "Hey, yeah, I agree, but we sell to buy what?" And then so that's the major issue they are facing for the core funds. As a result, I think it's a perfect opportunity for value add to come into the market because you have no competition for core spaces. So we see more and more value added players are coming in to become, once in a while, they can buy a better quality product, which doesn't need to be so high risk to come. That's what we are seeing now. And the core fund, I think most of the US core fund cannot do credit. That's the sad thing. They say if we can do credit, I'll put more money into the credit, but they cannot do it. So they stay on the sideline.
So would you say,
Oh, go ahead.
Earlier there was a slide, you talked about the difference in pricing between, say, Class A office
And Class B, right?
office, would you say that's kind of the biggest mispricing in the United States right now? Class B office?
I think selective Class B office will be, I think because of spillover demand, we are coming through. Because occupier tell you, like I talk about Dallas presidents and
Way more likely to get fully paid back, and get a much better return for our investors than if we had just jumped the gun and said, we don't know how long this is gonna last, and let's just forget it, take our losses now and move on. But yeah, and then a lot of these groups in the meantime to cover your losses. So yeah, it's been really interesting.
So a couple slides before this, I think you had the trend for cap rates going down, but then you also had a few before that, the 10, they're sticky to maybe slightly up. So how do you think the interplay between those two dynamics, which you think would kind of work in conjunction given the historic 10-year treasury? Is it just liquidity there's just so much capital out there that needs to come in the system, or?
I think initially we in the 10 years should be well below 4% before the tariff. So therefore our forecast for cap rate is a lot more aggressive compression.
Yeah.
But now just this, the cap rate compression is going to be a lot more milder. But that's on the national aggregated point of view. But what we are seeing, the devil are in the details. But what we are seeing for those prime assets in the right cities, early recovery, the cap rate will be very prominent. The compression will be very prominent.
I have another quick question. So if you were Powell, would you cut rates? It sounded like earlier you were of the view that unemployment was actually in an okay spot. Tariffs are a little bit more concerning, maybe with the unknown and inflation, I'm sure, coming back. So I felt like I would guess your answer would be to be slower to cut rates.
I think that first cut should be in September.
That's the house view.
That's the house view. But I need to respect the house view. But my personal view, probably not. Not in a hurry. That's why the timing is very important. And then sometimes when you try to against the consensus, you are the only voice. It better not to be a lonely voice. So just shut up. Say, okay, house view is right. But personal view, I just said now, even no cut this year. Because I keep saying the fundamental data and the sentiment data is misaligned. It doesn't move the same direction. And then to be frank, Powell did the right thing, doesn't cut from my point of view. And but the political pressure, all the things that how this. So. I don't know your view. No cut, one cut, two cut.
That's a great question. I don't know.
You're the SOFR-based lender.
And we also borrow for so
That's true.
it kind of nets to zero. I mean, I don't like. I think it's funny because I think in our industry, there's just this assumption that when the short-term rates get cut, the 10-year is going to go alongside of that. I don't understand why the assumption that people make.
I can see now it's not happening because our deficit is so big.
I mean, my thought on that would be, I hope there would be cuts to maybe incentivize growth to then help the fundamentals so that when the cap rates are sticky, then you can grow your way into the value versus like relying on the 10-year coming down, drop cap rates to bail out that investments is kind of, I don't know.
As a researcher, sometimes I always feel like it's nice to have a recession because always we have a recession, we can reset the price. And but now we just have a lingering around, not reset the price. That is not healthy, right? Once you feel like the equity market is more the bubble than real estate.
You touched on the public to private, I do agree with it because we're actually seeing a lot of those opportunities, we're chasing a lot of them as well. Where do you see the opportunities reside? Right? We're trying to take public marginally to private, and then we're currently working on that.
I will look at office REITs. Office REITs is no-brainer. And if you see the fundamentals, the office is on a recovery. And that you should, and the office on the overall sentiment, people still very negative on the offices.
Everyone for coming. Just want to